look at the trade data on your screen. The trade deficit number is at about 4.84 billion. Imports have come in at about 25.41 billion, if I'm correct. Trade deficit is in fact at the lowest level since March 2011. Ekta, what are the other figures that you have for us?
Well, right now I have no other figures except for what's flashing on the screen, but definitely a $4.84 billion figure for the entire trade deficit number is actually much better than what the street was expecting. There was a range of anywhere between 5 to around 7 billion in terms of what the street was working with. And remember that the trade deficit, however, has been narrowing. If you look at it from December of 2015, it was 11.6 billion. It went down to 7.6 in Jan. Feb, it was 6.5. And in March, it was at around 5.07. So if you can see, it's actually been on a declining trend all the way since December of 2015. Gold imports have shot up to 1.2 billion versus 900 million odd on a month-on-month basis. That's the important data to watch out for. Exports have come in at $20 billion on a year, $20 billion, which compares to 22.72 billion, which we did on a year-on-year basis. Now, we have to pull up how much they did on a year-on-year basis as well. They've done around $20 billion this time round, and they did around $22 billion in the same month last year. In April 2015, it was $22 billion, and they've done around $20 billion in terms of exports this April. So that means that there is a decline which is continuing for the export data. So that's a decline on a year-on-year basis. But remember that exports have been declining for multiple months now. So at least the extent of the decline has come down simply because also because of a high base impact. Oil imports have come in at around 5.6 billion. And we have Aditi Nayar joining in to take us through the trade data as well. Aditi, gold imports have shot up, but that was expected because we did have that, that disruption that we had in terms of all the jewelers which took place. So that seems to have settled this time round. But overall, how are you reading the data, considering that it's been on a downward trend all the way since December of 2015 now?
Eka, I only got the last bit of your summary, so could you just run through some of the major numbers?
We have the trade deficit data itself, which is coming at around $4 billion. Exact decimal figure.
$4.84 billion.
Yeah, okay, so that's $4.84 billion is the total trade deficit that it's coming at. We have gold imports, which is at 1.24 billion. We have the total export figure, which is at 20 billion, which compares to 22 billion on a month-on-month and year-on-year basis. And we have the import data. I'm not sure about the total figure, but I think it stands anywhere between 20 to 22 billion. But I'll apprise you on that in just a minute. But the numbers that I've given you for so far.
So, Ekta, certainly I would say that the overall export number and the number that you mentioned for gold imports seem to be in line broadly with what we were expecting.
Okay,
so,
imports are 25 billion versus 27 billion month-on-month. Go ahead.
So I think that's really where there is a significant dip as compared to expectations. We penciled in trade deficit for the month at around $7 billion. So certainly $2 billion less, and that's really coming in mostly from the non-gold imports, at the non-oil, non-gold imports. Now, this is a very tricky subset to really gauge what has led to the fall without really having the disaggregated data, because whether it's a good thing or a bad thing that the numbers have fallen like this is something that we'll have to really wait for the disaggregated data to see. But prima facie, certainly, did not expect further, although it is quite mild, but a further decline in
non-oil imports. Aditi, have come in at 19.7 billion versus 22.99 billion. So the non-oil imports, that's not non-gold, but nonetheless, non-oil is pretty much, you can guess how much it has been in terms of non-oil.
I think gold hasn't gone up terribly as compared to what it was last month. So really, it's the non-oil, non-gold that has come down and come in lower than what we were estimating. So like I said, the reasons for this is something that we will have to really figure out, whether it's something like fertilizers, for example, where the inventories are already very high, so it's not really going to give you a signal of any additional slowdown of demand in the economy, or is it coming in from something like, again, pulses, which could be more of a food management issue.
But Aditi, I just wanted to get your thoughts in on the export data, because the quantum of the export, the absolute amount, has come down on a month-on-month basis as well. It has been declining, but if you look at it, same time last year, same time last month, it was 22 billion, and this time it's $20 billion.
So, the fact that there is a slip between March and April is quite a normal seasonal trend. So that's not in and of itself something which is of a major concern. But definitely, like you said, we are still in a situation where the exports are falling on a year-on-year basis. So the fact that it's about $1 billion, $2 billion, $1.5 billion lower than what it was in April of last year, that is still signaling that there is some concern. We haven't been able to stem the decline in exports as of now. Otherwise, the fact that it's lower than the March number is very much in line with the normal seasonal trend. Here again, there have been some months recently where even the oil exports have picked up. So we'll again have to see whether it's the non-oil exports, which is where the weakness is coming, or is it the oil exports, which is a very understandable situation that oil exports may be on the lower side. So I'm just trying to take a look at some of the disaggregated data to really get an idea of where this 6% decline is coming in from. So petroleum products, for sure, I mean, there is a 28% decline, but that's about $800 million, so not a huge amount coming in from that side. I think textiles have also declined, engineering goods, lots of minerals and ores. It's a bit of a mixed bag. I mean, a lot of the cotton and other fabrics have also contracted. So certainly it doesn't seem to be very good news. Interestingly, gems and jewelry exports have risen 17% on a YOY basis. And if I remember correctly, even last month they'd gone up by about 5%. So little counterintuitive, I think not quite what we were expecting. In terms of the jeweler strike, which has reduced gold imports so substantially. But interestingly, the exports have still continued at a fairly healthy pace.
Well, I just wanted to add a couple of things. What we have got in terms of, imports, non-oil imports, is indicating actually a fairly steep fall in oil imports coming in at 5.6. Now, where were we in terms of oil imports, non-oil imports? Ekta, if you would have, the last number we have as of March 2016 is almost 30 billion. Non-oil imports. Hasn't there been a fairly big fall? What is the non-oil import number you have?
Non-oil, non-gold imports was 22 billion in March 2016, and it's come around 19 billion plus in this month.
Now, that's the point, month on month, look at the amount of non-oil, non-gold fall. And year ago in April, we had done 22.5 billion. So this is actually a fairly shocking fall. It indicates that our ability to absorb imports also has gone down considerably. So this would actually be a matter of indication of a slowdown as well. Clearly, prices of several products have also gone down. Maybe some of the ores that we import. But this is almost a fall of 15% in non-oil, non-gold imports from 22.5 billion to 19.5 billion. This it's also an indication of a fairly severe slowdown that the country is experiencing. I mean,
Lata, if I can
go ahead.
Just add something, about 1 billion of this fall in non-oil, non-gold imports is really coming in from three major items. One is fertilizers, another one is coal, and a third is iron and steel. So I think these three we need to perhaps set aside, because there are a lot of other reasons for why the imports in these sectors are falling, particularly iron and steel, with the concerted effort that the government has tried to make in terms of the minimum import price and other safeguard duties, etc. Coal, again, there's been a lot of push to improve sector production. Fertilizer, there is a large inventory that's built up. So I think we need to set these sectors apart.
Okay, I'll just give you the data on that. For one thing, the steel imports actually went up very sharply in the last quarter of the calendar 2015, when steel prices had dropped to $250. It was not so much in April that we felt the pain, but I think now we have the data. April 2016, the percentage change, the big falls have come In coal, coke, as Aditi pointed out, that is a 26% fall in coal. Petroleum products, again, a fall of 25. Those are the two things we don't have to worry about because there's also a price element over there. Iron and steel, it's a 28% fall. Again, I take your point that there could be a price fall as well. And perhaps artificial restrictions. But transport equipment, that has fallen by 37%. Project goods, 56%. It's a small base, but even then, electrical and non-electrical machinery, a fall of 20%. The point I'm trying to make is that there is also an industrial slowdown story over here. So while we will celebrate the fact that trade deficit is at historic lows of, 4 billion, and that would indicate that actually the Indian rupee will strengthen because clearly our software exports in a month are much more than this 4 billion and, indicate that dollar inflows are more than dollar outflows. We will probably have a current account surplus at this rate. But the sad point here is that also the economy is not able to absorb as much as it could. Okay, I think we'll have to wind up this conversation over here because the Bank of Baroda press conference is about to start.